Coming up today, the NASDAQ falls over 3%. Is this the start of more to come, or will they bounce back soon? Tesla tanks 13%, along with Alphabet Google falling hard. Short-term bonds rally, commodities still pulling back, trouble brewing in the housing market, and why I will no longer talk politics on this channel. Let's go, guys. Hey, welcome back, guys. Thanks for tuning in with me today. As always, financial markets keeping it very interesting and challenging for us all. S&P 500 snapping its 350-day winning streak of not having a 2% down day. Actually finished the day down 2.3%. And we can see that market color changing quite a lot at the front. A lot of risk on markets now underneath their 5-day and 20-day moving averages. In fact, we even got the S&P and NASDAQ already underneath their 50-day moving averages. Still got the Russell 2000 small caps hanging in there above the 20-day. Volatility's up across the board. Bit of a bump up in long dated yields. All growth sectors in the red today, and believe it or not, we've still got healthcare and utilities green across the board. It wasn't a complete bearish breadth of a day. There is still a big rotation going on underneath the surface, all of which I'll show you on the charts pretty soon. Let's just make our way through all major markets to give you the bird's eye view of what's going on out there technically, and then we can talk a bit more about the news and fundamentals behind it all. There's a look at the daily chart of the Magnificent Seven. So you're having quite a sharp fall there today as a group down 5.4%. Believe it or not, the Russell 2000 is still just below overbought territory, still well above its 50-day average. Might also surprise you that even on a day like today, we've still got more stocks hitting 52-week highs than we do versus 52-week lows. 106 highs versus 22 lows on the NYSE, and on the NASDAQ, 140 stocks breaking out to new highs versus 35 new lows. There's the VIX. Did get quite a spike there today, actually finished near its highs above 18. However, still not as high as what we were a couple of months ago, back in mid-April. We do have a little bit of backwardation in the volatility term structure with the 9-day higher than the 30-day, so we could still be in for a bit more volatility just yet. Sharp move up in implied correlations. Stocks starting to move like a school of fish again. However, the bond market still pretty sleepy. Not much volatility there. Same with oil and gold as well. Not much volatility. Was a bit of flight to short-term bonds today. 2-year yield dropping 443. 10-year actually sitting firm with TLT pulling back. We don't get that rotation into long-dated treasuries like we did for many years whenever there was a risk-off event. Now everyone's piling in to the short end of the curve, as that's definitely got more of a tailwind being on the cusp of Fed rate cuts, which I would say is still an outside possibility to come later this month. Markets keep selling off. It's really good reason for J Powell to get in there and start cutting rates. Looking at the price action in high yield bonds, not all that worried, just down 32 basis points, still sitting at the top end of this range. It's been in all year. Wasn't much of a flight to safety in the dollar either, pretty much trading flat. And the risk sensitive Bitcoin didn't come off that much either. It's had a pretty strong correlation with NASDAQ over the years, and it wouldn't be surprising to see Bitcoin off 5, 7, 8% today with the NASDAQ down so hard. However, it actually appears to be holding in there. Still got a bit of weakness in the overall commodity complex. We are looking a little short-term oversold here. Got some of my reversal signals firing off. There's no signs of a flight to safety in gold either, just pulling back below 2,400 an ounce. There's crude oil, pretty sleepy today as well. Short-term oversold. But like I said, it wasn't a bearish breadth day. We actually got some monster rotations. Here's the spread between value stocks and growth stocks. Up over 3.2% today, and a really swift move down in growth sectors versus defensive sectors. 4.29%. We have seen similar moves in the recent past. We can get these big swift rotations. Similar move at the start of the year actually. Growth versus defensive sector spread came off really hard, but it didn't last long. There's high beta stocks versus low volatility stocks, and I think we can draw on a bit of a support zone there. Keep an eye on that. Another big move in discretionary stocks versus consumer staple stocks. Down over 4% today. There's a spread in gold versus stocks starting to firm up there as well. Huge steepening in the bond yield curves. In fact, we got the 30-year versus 2-year back in positive territory, pointing towards the real possibility that a recession could be just around the corner, looking back in history. However, for the here and now, things are still holding up. Just looking at credit spreads of high yield bonds versus treasuries, they're still on an uptrend. And the market's expectations of inflation are still coming down. That should be a tailwind for equities. Looking across all stock sectors today, there's semis getting hammered down 5.4%. ARK Innovation, overvalued stocks, high beta, coming off hard. Consumer discretionary got whacked, down over 4%. Home builders having a bit of a pullback. Energy actually finished flat on the day. And like I said, it was actually healthcare and utility, the winning sectors of the day, finishing higher. And so that big rotation out of mega cap tech into small caps, value stocks and some other sectors just accelerated today. And so what we'll be looking at, is this a structural change in mega cap tech? Is the market pricing in their earnings growth really going to slow or reverse? Or is this just a short-term pullback in an otherwise healthy long-term trend? Media headlines are attributing this sell-off to some weak economic data we got out of Europe and the earnings from Alphabet and Tesla. However, I don't think that is the case. because we get that type of stuff on a day-to-day basis. And the fact is, Alphabet only fell 5% today. Meta, that didn't even report, fell 5.6%. And yes, we did get a big move from Tesla, down 12.3%. However, that's not even in the trillion-dollar market club at all. It's only $688 billion. Just looking at the price action we got across the market, with NVDA falling almost 7% on volume. There is a definite pullback rotation across all semis, one of the hottest sectors over the last year or so. Really large stocks like Broadcom and others down 7.5%. I've reorganized this watch list in my TradingView app as well, to better categorize all the stocks in different sectors. There's a look at financials, came off a bit today, and they're ranked by market cap in my watch list here. There's energy stocks, ExxonMobil finishing higher, material stocks, BHP, the largest in the world. Industrials came off. So did transports. Consumer stocks a little mixed. There's actually Coca-Cola and Pepsi trading higher today. But look at that in healthcare stocks. Apart from those weight loss stocks, GLP-1 from Eli Lilly and Novo Nordisk, the rest of the healthcare space actually firmed quite a bit there today. So typically in a really bad down day for the market, everything will get sold. It's almost like a liquidation event. Money just gets raised left, right, and center. What you're seeing here is a rotation, because you got some stocks like Thermo Fisher, Abbott Laboratories, and in utilities as well. My favorite, NextEra Energy, actually came in with solid earnings. Finished the day up 4.5% on really good volume. Chart still looks good. Uptrend is intact. And there's plenty of other utilities trading up and firming here as well. And so we shouldn't be surprised to see this pullback, especially in mega cap tech. The trade just got so hot, so crowded. It was working so good for so long, and the market just always repeats itself year after year. Whenever one sector or group of stocks does really hot, they inevitably have a pullback or correction, and who knows, this could go on further and deeper. Nobody knows for sure. We could be on the cusp of a sharp 10-15% pullback within the market, and I'm sure that would spook a lot of people out. However, that's well within historical norms. In fact, pretty much every year you'll get a 10% correction in the stock market. Every second year you'll get a 15-20%, and every 4 or 5 years or so you'll get a 30% or more. And even though we've had a bit of uncoiling on volatility in this market, we always get those big sharp moves off the lows in the VIX. Always hits real suddenly. Like I showed you, it could have been a lot worse. It's actually surprising to see Bitcoin hold up so well today, and plenty of healthcare and utility stocks finished higher. And so like I said, this tech trade, mega cap tech, AI and all that has got a bit hot. There's a lot of hot money in there. Fund managers, investors all around the world alike and chasing this trade. Both technicals and valuations did get a little bit stretched. You do quite see that often in the charts as well. The group of stocks will run up like mega cap tech did into the middle of this month. Like I pointed out there, we were 12% above the 50-day VWAP, which was an extreme. And so markets are often symmetrical. What goes up hard can come down hard. However, let's not forget, this is still well and truly in an uptrend. It's got a lot more work to do to start calling this a downtrend. And for sure, we could have further to go. However, when you see hard moves like this, it can quite often create a period of consolidation. Unless we get that sharp V-shaped bounce back, this can kind of just slow down and weaken the trend for a bit. Still not everyone's convinced. A lot of doomsday callers left, right, and center. I'm sure you'll see it all across your screen today. A lot of fodder out there to play with. However, there's still plenty of bulls as well. They'll be buying the dip. The earnings in these mega cap tech are still massive. They still have so much cash to spend on AI. They still planned on spending on AI. I would say we'd need a real crash or big problem in the economy for all of that to change all of a sudden. And let's not forget, presidential election years are quite bullish. Looking at this seasonality chart here, in the dotted blue line is all presidential election years. However, in the thick blue line is excluding 2008. And so we can often see a period of weakness, consolidation around here, like I've been saying for a little while. It can sometimes extend itself into September and October, where we'll normally find a bottom and then rally towards Christmas. Doesn't happen every time. However, we're always dealing with probabilities and patterns here. But like I said, we did break that really long streak of 350 trading days without a 2% drop. So this stat here will have to reset. And there has been such a sharp and vicious rotation from growth to value, large cap to small cap, just looking at these charts here. And it appears it's already shown up in the data as well. Just looking down here on the left, big institutional money has been bailing out of large caps off of late. I'd say that accelerated today. And overall, there's been net outflows. However, it's almost break even for small caps. And even though media headlines are attributing today's significant sell-off to what's happening with Tesla and Alphabet, I don't think that's the case, but nonetheless, it's still important. It is still a large stock that is well traded. Everyone watches it. So many people trade it. So if that's down big, that can flow on through the market to some extent. And they did miss on their numbers, with Elon confessing that competition is biting them a little bit. However, I'd say the long-term story and bullish thesis is still well intact, and in some ways has even improved. If you can zoom out past the short term and look a little further out than a few months, there's still plenty of positive optimistic things to come. Dan Ives saying AI will be the next thing to power their next phase of growth, with them given a robo-taxi launch in October. Very controversial subject, and for sure, it won't be easy to pull off if they can pull it off. However, if they do, the stock could absolutely skyrocket. And let's not forget the Tesla business is evolving. Energy generation and storage is starting to become a significant line of revenue for them, and that actually exploded this quarter. How many batteries and storage systems they're deploying across the world, both in the public and private sector. For a long time, Tesla skeptics and bears, Teslac, all those people that have lost billions on the stock, have accused Tesla of only being an electric vehicle company. While the bulls argue it's the world's #1 clean energy brand and company with plenty more potential and its best days ahead of it, it's going to grow into other areas. And this chart right here just confirms that is already happening. Also, a bit of pullback in Alphabet. However, they actually beat on their numbers. They still have the biggest and best search engine in the world, along with video platform. Goldman Sachs still bullish on the stock. They're going to be a huge beneficiary of the years-long AI boom. And on some measures, Alphabet Google is still the best valued out of all the mega cap tech. And I'm a long-term believer in the company and the stock. And so any significant pullback or dip is a long-term buying opportunity in my opinion. And I've got no problem in paying 22, 23 4 times earnings for a company like Alphabet, especially if we're going into a lower rate environment as well. And the consumer ain't all that bad. We've got stocks like Chipotle coming in with a pretty good earnings result. In fact, they posted second quarter earnings of 33 cents per share. Total revenue $3 billion. That represents a 32% and 18% growth from a year ago. That's amazing numbers for a business their size. Total visits to Chipotle restaurants increased nearly 17% year over year. They're definitely the favorite amongst a lot of consumers when it comes to fast dining. Stock had been getting sold off pretty hard these last couple of weeks. I'd say we're in for a pretty good bounce now. We were really stretched coming into this earnings, just trading up a little bit after hours, 4.7%, and I wouldn't be surprised to see this back above its 50-day VWAP in no time at all. And it's not just the lowest spending consumers that have been pulling back, it's also the top spending consumers. Worldwide luxury spending has been in a bit of a bear market. Saw that today with the world's largest luxury group, LVMH, of which I'm a long-term bull on, slumps 4% after second quarter revenue miss. Sales in Asia, excluding Japan, fell 14% in the second quarter from the same period a year earlier. However, in my opinion, it's one of the most high quality, if not the most high quality collection of brands in the world, all trading underneath one company, LVMH, run by the world's richest man. Very diversified, some of these brands, hundreds of years old. And he's got everything from wine, spirits, perfumes, fashion, retailing, watches, even has luxury hotels. And there's a look at LVMH, which trades on the Euronext Paris Stock Exchange. And like I said, luxury spending's been a bit soft and coming off these last couple of years. We also got Ford missing today and falling with no improvement to their full year guidance. Ford and General Motors still struggling to get into the EV space. They can't knock out these cars for a profit. Tesla still years and years ahead of them, and they're kind of caught in between a rock and a hard place. Whether to keep their foot on the gas towards EVs or keep investing in internal combustion engines, these businesses, their factories, infrastructure and assets are built on ICE vehicles. Can't just flick a switch and go to EV overnight, like Tesla's been built from the ground up. However, nonetheless, I still think Ford and General Motors are still very undervalued, even though they're well behind in the EV space. There's a look at Ford after hours, 5-minute chart, down 11.3% after their significant miss on earnings expectation. With General Motors not trading off too much in sympathy with it, it's actually still in a really nice uptrend this year. Both of them with market caps a little over 50 billion. And I think a lot of people would be surprised to know Ferrari is the third largest auto stock in the world after Tesla and Toyota. That's one luxury brand that has not been suffering. Over to commodities, we're having a bit of weakness lately, pulling back, led by crude oil. Actually finished a little bit higher today, as US data shows crude supplies down a fourth straight week. Still got a little bit of soft demand out there. China not having the best rebound in their economy, little uncertainties about the future, and looks like it's just holding ground below $78 a barrel. And I still continue to believe that we're in for a period of consolidation here, unless we get any big surprise catalysts come out of the blue. Got a pretty sharp pullback in the growth commodity of copper these last few weeks, down over 20% from record highs in 2 months. You can often see this with commodities. People underestimate how volatile they can get, how much they can spike, how hard they can come off, and we're seeing that with copper. However, just keep in mind, by the time it makes it to the headlines and we all start talking about it, that could typically mean it may be close to a turning point. Just moving on to the housing market, pretty similar story around all Western developed economy. Bit of signs of softness and pulling back out there. Not broad-based, there's still pockets amongst markets where property's holding up. However, there's other areas where it's starting to pull back. In the States, we've got new home sales hitting 7-month lows. These high rates still placing pressure on first home buyers. We can see that with new home sales on the chart here, towards the lower end of their range. And home builder inventory is actually spiking to the highest level since 2009. Back when we saw a huge property crash after record building, borrowing, speculation, low doc loans, all that good stuff. And that's starting to show up with sellers cutting their price. Looking at a bar chart of monthly share of active listings with price drops now towards the top end of that 7-year range. However, there's plenty of equity out there, especially in the boomer generation. They can well and truly handle a 20-30% pullback in property prices if we did get one, which looking back in history shouldn't come as any surprise as well from these current valuations. But just looking at household debt as a share of household net worth, that's down towards the low end of a long-term range, well off the GFC levels of 2008. Bit of a bubble in debt, especially subprime. So overall, especially older consumers, plenty of equity, not much debt, can easily handle a pullback in valuations, not the end of the world. But just looking at home builders, even though they're a beneficiary to lower rates, they could hold up here. Just zooming out to a monthly chart, I'm in no rush to get into home builders here, given that building glut of inventory. Starting valuations, it's had a pretty good run these last couple of years, and given the real potential for a sizable pullback in the residential market, this is one area I'm just going to stay on the sidelines for. Okay, so over to a bit of a hot topic on this channel lately, and that's my reporting and commentary on politics, which I've gotten plenty of feedback on. I've had some time to think about it, and even though I know a lot of you enjoy it and have encouraged me to keep going with it, I've decided to stop talking politics on this channel. And let me explain my reasons to you why. So first off, why was I talking politics on this channel? Well, it's something I'm personally interested in. I think it does play a lot into markets, and it's things I believe in. And this US presidential race has been quite full of twists and turns. And even though I'm a relatively small channel, I am still part of the overall media. And so I wanted to be a part of the solution, not the problem. Because again, personally, I don't like the direction of Western democracies and culture. If you study history, these things have happened before and it doesn't end well. And so as many of you know, I am a proponent of small government, less tax, less inflation, less corruption, less war. However, that doesn't sit well with a lot of people. But I think it's unfortunate that modern day culture teaches us that it's bad to talk politics. We don't want to upset anyone. So many people are sensitive these days. So it's funny, isn't it? We don't want to talk politics with a neighbor or a friend or a family member, so we don't risk upsetting anybody. But then what does that do? It creates a democracy that lives in darkness, where we can't even objectively discuss current day events or our leaders. We're just better off shutting our mouths. But what I've discovered is at the end of the day, the facts don't even really matter. It's all about perception. So now if someone tells me that pigs can fly, I'll say that's great. I won't argue with them. I'm also tired of the trolls and attacks, hate mail, having to block people, some people even requesting refunds if I merely state facts. Like a certain president had the lowest inflation of the last 8 presidents is enough to trigger them. Because in my opinion, the level of brainwashing and hate created by the mainstream media is truly a sight to behold. However, it's not up to me to try and correct that. And so I've drawn upon the wise words from much smarter men who've gone before me to learn from this. And so I apologize if my political views and opinions have offended you. That's not what I intended. And this will be the last time I ever share my political opinions with you on this channel. From now on, the focus will be 100% on markets. And even though politics does play a role in markets, I will keep it to a minimum and try and just report what's happening and leave my world views and opinions out of it. Which is hard because even today, there's speculation in markets that the mainstream media pumping Kamala Harris up in the polls and speculation that Biden may soon resign, with Harris taking over the White House, could be leading to this market sell-off and unwinding of a Trump trade. However, if I go too much into that, I'll have people coming at me, calling me a Trump lover and things like that, which I really don't have time for. Nor is it how I want to live my life. So I'm going to do my best going forward to leave politics out of this channel as much as possible. I will no longer report on the US presidential race and show the odds of those in it. My focus going forward will be solely on making money in the markets and nothing else. Also, seeing how Elon is getting treated now for speaking out with facts is something I can't be bothered with enduring either. I'm learning myself to try and accept the world for what it is instead of what it should be. So even if Kamala Harris gets 91 million votes, then so be it. You won't hear about it from me. And I'll still be looking for a way to make money in markets regardless of who's leading them anyway. So I just want to give a big thanks to those of you who have been supporting me on this, including sending me generous tips with words of encouragement. I really do appreciate you guys and look forward to exchanging our thoughts again on worldly topics when we meet up in person in Vegas. Otherwise, for this channel going forward, there will be no more politics, just purely market analysis along with the fundamentals and technicals. And thanks to everybody for sticking with me on that. And let's move on and get back to what you came here for, and that's to analyze the markets. Cheers. Okay, there's the economic calendar for today. There's those Eurozone PMIs, which did come in a little weak. However, looking at services and the composite out of the Eurozone, they're still in expansion territory above 50. Was a bit weak there on manufacturing. But the United Kingdom composite PMI, still in expansion territory, and doing even better, United States. 55 on their composite PMI. So I don't buy that whole argument today that some soft economic data from the Eurozone caused tech stocks to sell off 4, 5, 6%, along with Tesla and Alphabet. I think there's a bit more to do with it, including this massive rotation that we've been seeing in markets. Looking out till tomorrow, weekly jobless claims, durable goods orders, and GDP growth data. Friday, big one, PCE inflation data. Year over year expected to come in 2.4%, month over month 0.1%. And if that comes in low, that could set up a big, strong rally on Friday. Otherwise, if it comes in hot, we still may have further to go on the downside. Did get a little bit of pricing change on Fed Fund futures. Now pretty much pricing 100% chance we're going to cut in September. And I thought after the price action today, the chances of a cut later this month would have been a bit higher. Market's still only assigning that a 6.7% chance. However, if this sell-off accelerates, we get soft PCE this Friday. There's no reason for Jay not to go ahead, just chop off 25 basis points at the end of this month, because that could be a bit of a long wait till the 18th of September to go ahead and do the same. And just going down to the 5-minute chart after hours on the SPY as I speak, having a little bounce here, 27 basis points. NASDAQ as well, 41 basis points. Quite often see this after a big down day. We get initial bounce. Whether that holds tomorrow or not is another story. Wouldn't be surprised if we come down, hit my lower buy sell band on the SPY, which is around 527 or 5270 on the index. And as far as I can see, it looks like the markets will most likely hold. As we've still got breadth holding up, VIX is still below 20. Bond volatility is not going that crazy. Still got high yield bonds holding up. Bitcoin hasn't come off that much, and we're still seeing that rotation into utilities, healthcare today, and why I'm still eyeing off some biotech stocks. Nonetheless, another interesting day in the markets. Thanks very much for tuning in with Click Capital. I appreciate all your support, and I hope to see you back again tomorrow night. Cheers.